All right, ladies and gentlemen, we're going to get started here. We have a Wednesday webinar here, the seasonality of markets, the best times to trade. We're going to be talking about the best months of the year, the best hours of the day, the best days of the week to trade our markets. The prerequisites for this webinar, the three types of trading setups, the traditionals, the extensions, the 61.8% lines, how they fit together. The second prerequisite, the three types of entry strategies to trade those retracements. The third prerequisite, the three time frames to trade those types of trading setups. There are three time frames that those traditionals, extensions, and 61.8% line failures trade inside of, and using the past to predict the future. The goals of this webinar today are to identify the seasons of the year to trade, to identify the best days of the week to trade, and to identify the best hours of the day to trade the NYSE and the European markets, and to know when to employ trading strategies and techniques that complement the time of the year, the hour of the day. Studying the past. We all know, and we talked about this in the last webinar, how using the past to predict the future, how our markets repeat themselves. Patterns repeat themselves, even almost to the day sometimes. What has worked before and been profitable in the past can be observed and profited from in the future. That's why you see a lot of these markets that will look very similar year in and year out to themselves. Seasonal markets can be traded just like trends. We trade trends until they fail. We trade all types of trends until they fail. We trade extensions until they fail, traditional measured moves until they fail. Lately, we've been having unfilled gaps. That is a trend of unfilled gaps. Every single trend continues until they fail, and seasonal longs or seasonal shorts continue until they prove that they're no longer a trend anymore. Giving an example of a seasonal trend, gold, represented with these little orange boxes in July. For the last 4 years since the 2008 crash have represented an entry into a long that they have never been broken, even for swing trades. This is the fourth year, and we are off of our June lows. Let's talk about the big picture. How do we know what the big picture is? With our strategies, we use the monthly, the weekly, and the daily setups to give us a clear direction and target for our trends. So we have very specific opinions about where the market is going. Price patterns repeat almost every single year. In general, there are two different biases in the market. And I'm talking about, in general, the establishment is risk on and protect profits. Risk on and protect profits. Most funds in the market are long-only funds, dealing with 401ks, retirement accounts. The bulk of the money inside of our markets is long-only, and that's all they're thinking about. They're not thinking about being short or having a market fall apart. They protect themselves, usually in the summer. We'll talk about how that happens historically in a minute. Let's talk about the months of the year to trade. And I'm going to give you some links after we're done here, so you can get some data behind this. Bolkowski, the pattern site. You guys all know that I'm a big fan of all of his work, the Encyclopedia of Chart Patterns. And he has very similar data to this. This is what I have observed over the years, and it's also backed up with data. January, February, March are all bullish and extremely fast markets. April is the best month to sell. April and May are the best months to sell. They are still fast markets. You'll remember the saying of sell in May and go away. These are profit-taking months, April and May. April is the best month to sell, and May is the worst month to buy. May, and after May 1st, we start to slow down going into the summer. June and July are consolidation months, and August. Okay, June, July, and August, between Memorial Day and Labor Day, we have consolidations. They're medium, slow, and medium, with June and July and August being the slowest months. They're consolidations. August is the worst month to sell historically. Okay, we have extremely wide ranges. September is the best time to be a buyer. Into October, November, December, January, February, March, April. So you'll notice, and we'll look at charts here, and you can go back through 100 years of your charts, and I encourage you to do so, and look at the seasonality that we have inside of our markets. That there is what some people call a Santa Claus rally, but it starts much sooner, going into anticipating the fourth quarter being a bullish month. September, October, November, December, speed picks back up, excluding the holidays, but we have fast trading markets again. The slow time of the year, July and August, especially towards the end of August, are very slow during the day, but have extremely wide ranges. This template right here is important for a couple reasons. One, it helps long-term swing traders get into the market in bull markets, which we've had 99% of over the last 100 years. Two, it helps you know when not to be a bear, okay, coming out of consolidations. It also helps you in long-term swing trades stay in the market until the profit-taking time of the year. Most people think that the beginning of the year is the time that people put on new positions, but it's actually the beginning of the last quarter going into May. May is the time to take profit or hedge a position, and then think about it this way, that all of those hedge fund managers, mutual fund managers, basically go on vacation from Memorial Day to Labor Day. We talk about, and we're going to talk a little bit about this in a minute, about the days of the week. Everything happens much slower than anybody really realizes. It's much more deliberate, much slower, and methodical than most people think. That the S&P and the ES travel very quickly, but they're very slow. It's accumulation. Think about the middle months as the position is put on, it's hedged, and they go on vacation. And coming back in August, the end of August into September, they're putting on all of their new clients' money, putting on new positions going into the next May profit-taking spot. And then the consolidation, protecting profits, taking profits, new client money going into the market, taking profit into May. Okay? May through August are slow months and probably some of the most choppiest and worst times to trade the indices based on the ranges that exist and technical patterns that we've witnessed over the years. Let's look at some examples here, and we're going to look at the bull markets. I could have went back much further, and we can after we're done with this recording. But I want to point out the last two bull markets that we've had coming out of the 2003 lows. And from September of 2003, which 2003 were our lows in our 50% longs, to May, we had accumulation. As soon as we hit May 1st, it was a high, the sell in May and go away, and then we have a consolidation represented with the yellow box. Okay. If there was we have specific trends that we have targets for, but this is the much larger time frame. Think about it as this type of pattern, not necessarily as entries and exits, but as a map, a general direction for the market. Not with specific entries and targets, but to help us gain a better understanding about the trends that we see inside of our 50% to negative 23% targets. In May of 2004, we saw profit taking, a consolidation during the summer. At the end of August and beginning of September, we see more accumulation straight into the beginning of May, where we have more consolidation. At the beginning of September, August, the end of August, actually we had the beginning of September and October being the bullish setups going into the May of the next year for 2006. So 2003, accumulation, summertime 2004, consolidation. The fall of 2004, accumulation, summertime of 2005, consolidation. The fall of 2005, accumulation, and we're going to go here to 2006, accumulation off of May highs. You can see here. August and September, accumulation. In 2006, consolidation and profit taking coming out of May. September of 2007, accumulation. Going into 2009, consolidation. September 2009, accumulation. Going into May, profit taking and consolidation. September, August and September, accumulation inside of 2010, 2011. Going into the summertime of 2011, consolidation. Obviously deep sell-offs here. This is QE1 and QE2. So it's going to look obviously much more volatile. Consolidation, sell-off, profit taking, right? October, September and October of last year, accumulation into where we are now. Accumulation, September, accumulation from last year into the exact May highs, which were highs of our market, profit taking. We're in consolidation right now. The question is where will September, the end of August, and the beginning of September, where will be our accumulation? Where will it come from? See, the patterns in the market show us much different historically than we normally see right now. And we'll see going into September and October this year where our accumulation comes from. So those are some examples of what we just talked about inside of those seasonal, bullish, and consolidating markets. Let's move on to the days. These we're talking about the months and the years. We're talking about the much longer term time frames, the investing, the wealth creation. Let's start getting into the more trading, intraday, and talk about the days of the week. The days of the week are always the same. It doesn't matter if it's at the beginning of the month or the end of the month, the middle of the month. It doesn't matter if it's at January or August. Every single week is the same as far as days of the week. They always start out the same. They always end the same as far as speed and volume and participation go. Mondays are slow. Traders are digesting the news from the weekend. They're analyzing the risk and the news for the week and the risk that they have on, and they're designing a game plan for the week. Now, you can imagine that if you're in September through May, you're in accumulation mode right now. If you're in the June, July, August months, you might be somewhere completely else. If you're a money manager or a hedge fund manager, you might be accumulating new buyer funds, but you might not be putting any risk on as of right now inside of the market at this time of the year. Tuesday, and this is Monday night Tuesday, starts the fast heavy lifting, and we call it the heavy lifting because all of the work is done Tuesday, Wednesday, Thursday. It's fast. Volume comes in, is risk on. Wednesday, fast volume comes in, risk on. High participation. Thursday, fast volume comes in, risk on situation. Putting on accumulation, putting on positions. Fridays, once Thursday night, Friday hits and the European session closes, the markets are dead. Historically. We've had some wild price action this summer, with especially last week and the week before. But that's more of a product of the summertime, wild intraday ranges. Fridays are typically slow. There's profit taking for the week or hedging, either by closing positions or hedging the week's gains with futures. It's risk off until Monday. You protect what you have to see if it sticks going into the weekend. In your position is what is important. Let's look at an example of a volume chart here. I just pulled a volume chart from a day on the ES. And the ES represents the volume for most of our markets. You'll see a Monday, Tuesday, Wednesday, Thursday, Friday, Monday here. The lowest volume and slowest markets are at the beginning and end of the week. The highest volume and fastest, most technical trades are in the middle of the week. And you'll see here on Mondays, they start off slow. We have our highest volume at the beginning of the day, and it slopes off in the middle and ramps up to highest volume at the end of the day. We're going to be talking about this when we talk about the hours of the day. But you can start to see a pattern for every single week. Slow to fast to slow. The heavy lifting starts on Tuesday. We ramp up and are putting on positions, whether they be long or shorts. It depends on what trend we're in. We're not talking necessarily about whether this market is bullish or bearish. It's just putting on positions in whatever trend that we're in. That's where the volume comes from. It can be either long or short. Volume comes in towards the end of the week. Volume tapers off. Participation ends. And the trend slows to almost a crawl, typically on Friday afternoons. Okay. I want you guys to take note here of the volume during the day. These are the hours of the day. And on Monday, they dip in the middle of the day and they ramp up at the end. Tuesday, they are at highs. They dip towards the middle of the day and they ramp at the end. Wednesday, they're high volume at the beginning of the day. They ramp up at the end. Dip in the middle, ramp in the end. Dip in the middle, ramp at the end. Dip in the middle, ramp at the end. Dip in the middle, ramp at the end. Let's talk about the hours, the best times to trade. This is what we're talking about when we drill down to putting on brand new positions. Okay. I consider the beginning of the trading day the German Open. Europe begins the trading day. It's not New York. Okay. The beginning of the 24-hour clock. It begins with Germany, it ends with Asia. 2 a.m. Eastern Standard Time is the German Open. It begins the day. It's the break of the slow, choppy price action of the Asian session. Okay. Now, when you're coming into the Asian or the German Open, you're not necessarily looking for a setup, but you just want to be, at least what I'm looking for, is observing whether Germany was bullish or bearish in a long or short setup. Are we in shorts? Are they bidding a market up? Or are we in longs and they're offering a market down? Because at 3 a.m. Eastern Standard Time, the London Open, it is often an exact reversal of the German Open. Many times if we're in bearish setups, Germany will bid a market up into a European short. Just the opposite is true if we're in longs on the euro. Germany will offer a market down into a European session support level, and it will be an exact opposite of whatever the 2 a.m. Eastern Standard Time frame was. It's very important to watch those time frames. 3 a.m. Eastern Standard Time is the London Open. Again, this is often an exact reversal of the German Open. 4 a.m. Eastern Standard Time is not normally an important level. And we have not typically historically talked about it. But over the summer, what we've noticed is that on Monday night, Tuesday, the very first high participation day of the week, there's a little lag. And volume comes in not at 3 a.m. Eastern Standard Time, but 4 a.m. So the very first high participation night, Monday night, Tuesday, right when we normally anticipate, right at 3 a.m., the 4 a.m. is normally when markets start to open. It's normally at the beginning of the week, volume comes in 1 hour late. So it's important to note that Monday night, Tuesday. 5 a.m. Eastern Standard Time is the beginning of Europe's daily doldrums. We usually witness profit taking in the direction opposite from whatever the main direction of the morning was. So if at 3 a.m. Eastern Standard Time, Tuesday, Wednesday, Thursday, there was a long setup, by 5:30, there can be profit taking going into their lunchtime trade, just like our daily doldrums. Okay, those European doldrums last until 7:30 a.m. Eastern Standard Time. It's a 2-hour lunch. The end of Europe's daily doldrums, this is many times a stop run from a consolidation, from a slow, choppy lunchtime trade. There's usually a consolidation during that daily doldrum on the euro. Then we get into 7 a.m. Eastern Standard Time. We're starting to run into the NYSE Open now. The 8 a.m. to 8:30 a.m. Eastern Standard Time. Europe's coming back from lunch. Everybody in New York is waking up. This is 90 minutes before the opening bell. 8 o'clock to 8:30 is historically the entry into the gap fill for the open. What you're looking for during this time frame is if you're below the gap fill and we're filling to a gap fill above, you're looking for a break of a short and a pullback to buy into the gap fill. Nothing complicated. 90 minutes before the bell rings. If we're above the gap fill in price, what you're looking for is a series of measured move longs breaking to give you an entry into a new measured move short into the gap fill 90 minutes before the open. 9:30 a.m. Eastern Standard Time is the open. There's a no trade zone. 10 o'clock, the best times to trade. Most big money will wait for the first hour after the bell to place their trades of the day. The 10 a.m. time frame produces more entries than any other time frame. It does produce more entries into a trend than any other time frame. If I had to tell you guys 2 times to pay attention to the market, and only 2 times, and you were only trading for 15 minutes around both of these times, it would be from 10 o'clock to 10:15 and from 3 o'clock a.m. Eastern Standard Time to 3:15. There are more entries that happen in the first 15 minutes from 10 o'clock to 10:15 and from the European session from 3 a.m. to 3:15 than any other time. The Europe Open and where volume comes into the NYSE Open. Okay. From 10 o'clock until 11:30, we have that fast trade. It's risk on. Markets are trending. There's high participation. There's high volume. And then we run into the European session close. 11:30 a.m. Eastern Standard Time is 30 minutes before the European session close. It's called the 11:30 reversal period, the beginning of the daily doldrums. We usually witness profit taking in the opposite direction, wherever the main direction of the morning was, meaning that if 10 o'clock a.m. Eastern Standard Time was at bid, a long off of support, 90 minutes later, you're going to be looking at taking profit. It doesn't matter whether a target has been hit or not. If you have the ability to, take partial profit. Take partial profit. Because there is normally a reversal at 11:30. Everyone else is looking at taking partial profit or hedging up their gains going into lunch. I like to think of an analogy when we talk about these big money players. They're taking the entire summer off from Memorial Day to Labor Day. They don't do anything on Mondays. They probably come in late at 10 o'clock in the morning. Don't do anything the entire day. Talk with their buddies about what happened over the weekend or how their kid's soccer game was. And then they leave early on Fridays. I like to imagine this type of person because I think that for the most part, that's what they really do. At 11:30, they're talking about where they're going to go for lunch. And then that's what begins this slow time of the day from 11:30 until 1:30 to 2 o'clock Eastern Standard Time. This is 1:30 is the end of the daily doldrums. This is many times a stop run from a consolidation of the slow, choppy lunchtime trade. And the daily doldrums will give us clues as to which way they're going to go. And we have the bank, breadth, divergences, and the major trend. The major trend, the bigger it is, the more powerful it is. And then we have the last part of the day. From 2 o'clock until the end of the day, we do have moderate volume. There are 15-minute trends that are completing. 3 a.m. to 3:45 p.m. Eastern Standard Time, the half an hour mark to where the 15-minute mark begins, is the last volume push of the day. It's an attempt to run towards the daily pivot for the next day, meaning that if we are above the daily pivot, normally we'll make a pullback into it if we're above it for the next day. What you would recognize that is trading hours only all the way halfway back. Okay. Let's talk about the worst, absolutely the worst times to trade. The times that you don't want to trade. 6:30 p.m. Eastern Standard Time to 2 a.m. Eastern Standard Time. The Asian session. Now, there are Asian contracts that you can trade that are trending. They will have participation, as in the Aussie dollar, and gold has a tendency to trade during the Asian session. But the ES, TF, YM, NQ, Euro, Pound, Canadian dollar, most of our markets are slow and choppy. Too slow and choppy to trade. The other bad time to trade is Europe's daily doldrums, 5:30 a.m. Eastern Standard Time to 7:30 a.m. Eastern Standard Time. It's when Europe's at lunch. Excluding 15-minute trends, you want to stay out of the micros during the European session doldrums. We have the same rules for the NYSE doldrums that we have for the European doldrums. And that is 15-minute trends only. What is the other bad time to trade? The indices only from 9:30 until 10 o'clock a.m. Eastern Standard Time. The first half an hour is full of reactionary trades on the ES. It's the worst on the ES. That first bell is when all of these overnight, whatever had happened overnight, the stock positions that are getting taken out, whether their stops are being hit or not, people are using market orders on the ES, and that drags all of our other indices around. The key to the gap fill, and most gap fill teachers, and how I was originally taught, will tell you the percentage fill of any given day. And they will tell you to go either market long or short at the bell. And if you've ever tried that, okay, it's a bad idea. We have it in a whole 90 minutes of price action that leads us into a gap fill every single day. And if we don't have an entry into the fill in that first 90 minutes, don't trade it. Let it fill by itself. It just didn't give you an entry. But that first half an hour is the most dangerous of any of our markets. There are sometimes valid setups, but for the most part, they are whippy. They don't have to hit first targets. They produce full stop outs. It's better to sit them out. Let's talk about the other bad time to trade, our NYSE doldrums. 8:30 a.m. Eastern to 1:30 p.m. Eastern Standard Time. Our NYSE daily doldrums. Trades should be limited to 15-minute trends only, just like Europe's daily doldrums. If it's a 15-minute trend and it has a 70 pip target, we can justify trading that setup. Just as if the ES has an entry into a 15-minute trend that's highly participated on and has, say, a 15-point target or an 8-point target, we can get a reduced risk trade on that specific setup on a 15-minute trend because there are a lot of people that see it. The reason that we limit to 15-minute trends during the doldrums is because, one, it limits the amount of trades that we make, which is a good thing, and it sets us up for better risk-reward trades. 3, they produce, the larger they are, the higher participation they have at their 50% to either reduce risk trades or, in the Euro's case, during its doldrums, free trades. During the doldrums, you do one of two things. Trade 15-minute setups only at their specific entry. 2, sit on your hands. Or 3, manage a position. There aren't any other options. Why are all these facts here important to our trading? Having knowledge about the seasonal speed puts us ahead of other market participants. Knowing the seasonal bullish and consolidating times of the year helps us plan for future trends and targets. And 3, if we match the speed of the market and we know what times that we shouldn't be trading and produce bad or harmful effects to our trading accounts, it's be the ball. We match the speed of the market. Okay. All right, guys, that is the end of the seasonal and best times to trade webinar.